The Strait of Hormuz is closed. Every fifth barrel of the world's oil flows through this choke point, and with it shut down, Brent crude has breached $115 a barrel. For decades, a supply shock like this, paired with inflation at 4.5%, meant an automatic recession. When energy costs spike this fast, growth usually stops. But the data for the first quarter of 2026 shows a massive contradiction. The U.S. economy didn't shrink. It grew by 2.0%. Compare that to the Eurozone, where growth has stalled at 0.8%, and economies are struggling under the weight of rising energy costs. We have entered the Great Divergence. The era of global markets moving in lockstep is over. Today, capital is aggressively flowing away from economies and sectors that live on promises and toward those that can prove they are executing. To build an allocation plan for this environment, we have to look past the headlines and analyze the data across the macro landscape, tech earnings, and the shifting housing market. Passively holding on to old safe havens is no longer a viable strategy for wealth preservation. Surviving 2026 requires an active reallocation into the sectors that are actually winning the divergence. That 2.0% U.S. growth in Q1 wasn't an accident. It was built on two specific pillars: a massive 4.4% rebound in government spending and a surge in physical AI infrastructure. Data centers alone accounted for an estimated 75% of that GDP growth. The question for every investor is how the U.S. economy is managing to grow while oil remains above 100. This chart shows the energy intensity of the U.S. economy, the amount of oil needed to produce $1 of GDP. Compared to the 1970s, our digital and service-heavy economy uses significantly less oil. We have effectively decoupled our growth from energy prices. The Eurozone hasn't achieved that same decoupling. Their growth has slowed to 0.8%, while inflation has spiked to 3%, driven almost entirely by the rising cost of importing energy. This has put the European Central Bank in a trap. They are holding their rate at 2%, unable to cut it without making inflation worse. Major financial institutions, including BNP Paribas, expect a forced June rate hike. The risk in the U.S. is different. If the Fed keeps rates high to fight that 4.5% inflation, we could see a squeeze on consumer spending later this year. However, the data suggests the U.S. is the structurally safer bet. By moving capital here, you trade the risk of European stagflation for a more predictable inflation risk that the U.S. economy can handle. In April 2026, the tech market split in two. The earnings reports from Alphabet and Meta revealed exactly how the market differentiates between investment and waste. Alphabet sits top right, high spending, high revenue. Google Cloud reached $20 billion, turning a $460 billion backlog into cash. Conversely, Meta projects up to $145 billion in capital costs without a specific revenue timeline. On this chart, they are stuck in the speculative zone. The market response in April 2026 was immediate. Alphabet shares rose 34% in a single month. Meta's stock dropped 9% on the day of its report. The lesson for the rest of 2026 is that investors no longer have an appetite for vision alone. They are willing to fund massive infrastructure builds, but only if they see a quarter-by-quarter path to profitability. When allocating tech capital, the strategy must pivot away from speculative bets and exclusively toward the companies that are already monetizing the AI cycle. We see this same divergence in the U.S. housing market. For years, homebuyers have been on the sidelines, waiting for prices or rates to fall. In April 2026, the math finally changed. Mortgage rates for a 30-year loan dipped to 6.3%, while national housing inventory rose by 20% compared to last year. Because rates are dropping faster than home prices are growing, the monthly cost of owning a home is decreasing for the first time since 2020. This heat map shows the opportunity isn't even. Coasts remain red with low inventory and high prices, but across the Midwest and emerging Northeast, inventory favors the buyer. Cities like Grand Rapids, Milwaukee, and Columbus offer job stability and housing. Here, the math works. Real estate success this year requires ignoring the familiar prestige of coastal cities and following the inventory toward these emerging corridors. To navigate a divergent economy, you need a plan that follows the data. Here are the 4 steps to execute for the rest of 2026. Step 1. Macro de-risking. Trim your broad European equity exposure. The ECB's inflation trap makes those markets more vulnerable to the ongoing energy shock than the US. Step 2. Tech reallocation. Liquidate your positions in companies that are spending on AI without clear revenue. Move that capital into the proven cloud infrastructure plays. The next test for this strategy is the Q2 earnings season. Watch Microsoft's Azure results and Amazon's AWS. These are the barometers for whether the AI monetization trend is holding. Step 3. Real estate. If you are financially ready, stop waiting for a national market crash that the data doesn't support. Focus your search on the green zone markets in the Midwest, where inventory is actually rising. Step 4. Income optimization. The same divergence rewarding proven utility in the markets is now dictating the creator economy. High-value data is commanding a massive premium over general entertainment. Look at the YouTube RPM data. While entertainment content averages a few dollars per thousand views, data-dense finance content is earning $35 to $45. Advertisers are aggressively paying for access to an audience that is making financial decisions. The 2026 algorithm has shifted to prioritize satisfaction over watch time. If you are creating content or skills, you win by providing an exhaustive, verified answer to a specific problem, not by chasing broad clickbait. Wealth in this economy belongs to the people who can separate hype from execution. Do you think AI will eventually replace investment analysts, or will it remain a tool for those who know how to use it? Let me